Hello and welcome to this edition of Investment Insights. I'm Jamie Gordon, editor at ETF Stream, and I'm delighted to be joined today by Eoin Moran, Senior Capital Market Specialist at Vanguard. Eoin, thank you very much for joining me today.
Great to be here, Jamie.
So your colleague last time spoke a lot about the increased choice in the ETF landscape here in Europe right now. For investors, what should they consider when they're thinking about this huge breadth of choice they're now presented with? And is choice, more choice, a good thing for investors?
Absolutely, it's a great question. We undoubtedly feel that greater choice is a great thing for investors. We at Vanguard are focused on bringing more products to market. We believe greater choice gives investors a greater ability to pick a product that will best help them to achieve their individual investment objectives. However, choice also brings complexity. It can be more difficult to pick the right product for your given circumstances. And if we look across Europe, there are now over 2,400 ETFs in Europe, and over 380 products came to market last year alone. So that begs the question for investors, how do they pick the product that is right for them? We believe it's important to start with your investment objective. What are you hoping this new product will achieve when you add it to your portfolio? Are you looking for capital appreciation, preservation, diversification, or hedging? And considering the new product through that lens can be a very helpful starting point. However, unfortunately, the decisions don't stop there. Even within products, we see a great array of choice for investors within specific product segments. If we take the base S&P 500 index, for example, there are over 70 products in Europe that track this specific index. Again, we think it's important for investors to start with their investment objective when selecting a product within this product universe. Do they want a product that is physically or synthetically replicated? Do they want a product that is active or index tracking? Are they looking for a product that will pay out their dividend through a distributing share class or accumulate the dividend within the fund itself? Going through this type of decision process can really help them narrow down the right product for them. Once investors are at a point where comparing comparable products, we feel cost is a very important variable to consider. At Vanguard, last year we returned over 22 million in annual cost savings to investors in Europe. Not only do returns in investing compound, but so do costs. And it's important to consider your total cost of ownership when assessing your product that you want to choose. When I say total cost of ownership, we believe it's important to look beyond not only your headline ongoing charge figure, but to look at the transaction costs for a given product. The analogy I like to use is when you're purchasing a product, you not only look at your purchase price, you look at the shipping costs that it will take to get that product into your hands. An ETF is no different. When considering an ETF, it's important to consider your costs of holding the product and the cost of trading in and out of the product. For investors with shorter time horizons or who are more actively trading in and out of a product, transaction costs can actually be greater than the cost of holding the product itself, highlighting how important it is to consider your total cost of ownership when selecting a product. In terms of assessing costs, the bid-offer spread is a helpful starting point. And for more complex trading circumstances, there is also a capital markets team available at Vanguard who can help you with pre- and post-trade trading analytics to help you understand what your cost will look like when entering, but also when exiting a product. To come back to your original question, choice is a great thing, but choice also creates complexity. By starting with your investment objective and keeping a close eye on costs, investors are in a great environment to choose a product that is suitable for them.
That 380 figure you mentioned there, new products, it's absolutely colossal. You delve into things like costs and other considerations to make there. When investors are assessing new products, from a cost perspective and also implementation, whether they're getting the exposure they want, how can investors assess products that don't have a track record?
Absolutely. It is incredible the proliferation of products that we are seeing in Europe. I know you spoke to Sophie in the last edition about some of the drivers behind that. But it does raise interesting questions for investors on how to select a product which doesn't have a track record, as you say. I think there are a few things investors can think through. Firstly, looking at the issuer that is bringing this new product to market. We're actually seeing a lot of new issuers coming to the market with UCITS ETFs recently. Last year, there were over 25 issuers who brought product to market for the first time. With those new issuers, it's helpful to consider, do they have the right people and processes to manage this product and ensure that you can receive the investment objective that is being promised? For existing ETF issuers, it can be helpful for investors to look at their track record with that given product that they're bringing to market. For example, if it is an index tracking instrument, they have a strong track record of returning the index return. And for active products, do they have a strong track record of alpha in that given segment? You mentioned costs and assessing costs for newer launched products. Again, keeping a key eye on the headline OCF can be helpful here, but also referring to the transaction costs I referred to earlier. We also hear from investors the difficulties of assessing trading costs for new products when they come to market. When they look on screen, they don't maybe see the liquidity they're used to seeing for more mature products. And it's at this point that we stress to investors the magic of an ETF is the creation redemption mechanism and the ability for authorized participants to bring new shares to market and to redeem shares directly with the issuers. As a result, liquidity for an ETF is really driven by the underlying market that the product tracks. It is therefore possible for products, even though they don't have a long track record, to be able to interact with that liquidity at a very low cost, even as the product is just brought to market.
So even though products might seem like they don't have a track record, they're often entering a universe of existing liquidity in the underlying and just adding to that themselves rather than coming in blind as a completely new fixture to the market, I suppose.
Absolutely. As investors consider new products that are coming to market, they should really consider not only the frontline liquidity they see on screen, but also the liquidity that supports that product. And that will be driven by the benchmark and the investable universe that that product is tracking.
Eoin, thank you very much, sir.
Thanks very much, sir.
And thank you very much for joining us for this edition of Investment Insights. Come join us next time where we speak to the Vanguard team once more about how ETFs are trading. Until then, take care.